Hi, I'm Ty Carr, and I provide business and tax planning advisory services for entrepreneurs and their accountants. My topic in this video is LLC and partnership taxable income. More specifically, I want to address the question, what is a partnership's taxable income? And when I talk about partnership in this context, I mean either a true partnership or perhaps what we see most commonly, limited liability companies, LLCs, that happen to be taxed as partnerships, and so they're treated that way for federal income tax purposes. So the reason I raise this question of what do we mean by partnerships taxable income is that, as many of you may know, a partnership flows through its income to the owners. So the partnership doesn't actually pay tax. So what are we talking about when we say the partnership has taxable income or the partnership's taxable income? Well, it turns out that the statutes, the Internal Revenue Code, actually has a definition for the term partnership taxable income, but it's really not helpful because it's not what you're thinking. It's not what most business owners or their accounting teams are thinking when they talk about partnership taxable income. I would propose that when you think about your LLC or your partnership having taxable income, what you're probably thinking about is the separately stated items of income or loss and the ordinary income or loss that flows through to be taxed on your personal tax returns or on the owners of the LLC's tax returns, for example. So that is the sum of the separately stated items and all the ordinary income is what we normally think of as the taxable income of that partnership or that LLC. And so that's what I will call it, and that's what I'll refer to as the taxable income of the partnership. So if you haven't seen that before or been familiar with that idea of separately stated items and ordinary income being components of the partnership's taxable income here, it raises this question of, well, why are there these different components? What is a separately stated item? Well, in general, when we say a separately stated item, I'm talking about anything where the character of that item of income would be a matter of consequence at the partner level. And that's kind of an intuitive definition. There's a more legalistic definition, but what I'm getting at with the intuitive definition, some examples of this would be, not an all-inclusive list, but examples would be things like qualified dividends, which an individual partner may have a preferential tax rate for, or capital gains, which they have a better tax rate for, or capital losses, which may be limited, or charitable deductions, which end up being itemized deductions for an individual partner rather than a business deduction. These are all items, examples of separately stated items that have a different character for reporting purposes, for deductibility purposes, and potentially for the tax rate purpose for the final owner's tax return. And so it makes sense, you kind of think about it, those should be separately stated. Mechanically, it helps that they would be separately stated, and in fact they are. And so when I'm thinking about, well, what would be separately stated, that's what I initially consider is, well, what items would we have to handle separately as different issues on the ultimate owner's tax return when this income or loss is flowed through. Now, there is an exact listing, so the technical definition or the exact definition of what is separately stated versus your operating income or your ordinary income is found in the Treasury regulations, and it's listed on the Form 1065 Schedule K1. So you can see kind of the list of the common separately stated items right on the tax forms. That way you're not guessing or having to kind of use intuition the way I described. I think intuition's helpful just to kind of get you started down that path, but it's always best to actually look at the form and see, well, what boxes do you have to consider filling out in your particular case. So how much, if the partnership taxable income is really this ordinary income and separately stated items, and that's what makes up the partnership taxable income, another question on this that I'd like to address is how much of that separately stated items and ordinary income gets allocated to each partner? And the answer to that is, well, the partners or the owners of the LLC, the members of the LLC as it may be, should agree to that point. So this should be part of the partnership agreement, part of what we call the operating agreement for legal purposes, should be an agreement as to how income and loss will be allocated. Now, most commonly what I see is that that agreement is done for profits and losses, so just a percentage is quoted. It's partner A will get X percent of profits and losses, and partner B will get Y percent of profits and losses, right? So usually it's some statement of that nature that says how much of the profit or loss allocation goes to those partners, and then as accountants, we can follow along with that in preparing the partnership tax returns and each partner's K-1s. The tax law does contemplate the possibility that you actually have an agreement that allocates a different agreement for each line item. Each separately stated item versus ordinary income could be allocated, each with its own allocation method or its own agreement. That's contemplated in how these rules are structured, although I'd say I've never personally seen that. I've kind of thought about the possibilities of why you might do that in some cases, but it's not something that I see happen. I said I've never seen that, but I've actually seen that a couple of times, but it's pretty rare, and it's not something that that you see happening regularly. The most common thing in kind of the boilerplate operating agreements that you see is they either just forget to mention it at all, or they just provide a single percentage for profit and loss sharing percentage that covers everything. Now, if they just don't mention it at all, there's no explicit agreement, then you get to the second bullet point that I have here, which is, well, then you're kind of left to state law to determine how the economic income is supposed to be allocated. So there's going to be a default rule in whatever state you're operating in, and then the tax return should follow that, right? Because taxable income should follow the economics of the partnership as defined in state law. So your accountants or your advisors knowing what the state law answer is to your allocations is important if you're not going to put it in your actual agreement. Mechanically, the total of your separately stated items and your ordinary income is reported on a Schedule K on the Form 1065. So it becomes part of the tax filing that goes to the IRS so that they know what income this partnership had. You also attach to that the Schedule K-1s, which shows each partner's share of those items of income. And so that goes to the IRS, and then each partner, each one of the owners of this business, or members of this LLC, for example, get their own K-1. They get that K-1, which they can then use to enter data into their own 1040 tax return, or if they're not an individual, whatever business tax return they do, they can enter the data into their tax return straight from their K-1 so that they can make their own tax filing. So that's it for this topic, talking about what we mean by partnership taxable income. I hope it was informative and that you enjoyed it, and I look forward to talking to you for our next topic.